Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. The break above the third of three resistances, the neckline of the February to April 2023 head and shoulders continuation pattern, currently 84.60, back at the start of March, was the beginning of this recent move higher. This resistance was breached and broken as the recent move higher originated from the base of the congestion between 83.46 to 84.40, containing the September 2012 high at 84.24, the February 2013 high at 83.50, as well as back then the long moving average, currently 86.39, also the medium moving average, currently 90.03. The initial journey higher was a tortuous one, yet the market built on the congestion below 84.40 plus the short medium moving average back then. It's currently at 94.82, and finally a golden cross at the start of March and staged an eventual move up over this neckline. So what happened next? Well, there are two parts to the answer. Back 10 weeks ago I said the following, and I quote: if the action over the last 3 weeks, so that is 13 to 10 weeks ago, the action over the last 3 weeks may have left us with a question. Is this action a bullish halfway hesitation or is it a potential double top? End of quote. Well, this pattern became a bullish halfway hesitation and both the primary target and a harder to reach secondary target were achieved. Since then, prices continued traveling higher. And indeed, we have this week made new all-time highs. The second part of the answer has been the treatment of the action over the whole of March, in that we made a beautiful, if very acute, March-based bullish Andrews pitchfork, highlighted in dark blue on my daily chart. The market followed this bullish pitchfork, creating a pipe top in late April, but still moving higher until this week, when yesterday prices broke up and out above the upper tine, currently at 10.795, at a fairly steeper angle than even the bullish Andrews pitchfork was at. Does this mean that the pitchfork has finally failed? Well, not necessarily. You see, it's still fairly early. It's early enough to be just a breach, and we could see prices back down within the pitchfork again soon. Still being bullish, but within the pitchfork. Additionally, we have an opportunity to draw a new late March to early May bullish Andrews pitchfork at a steeper angle to take into account the move higher. However, when I drew it on this on my daily chart, it made the view so messy, even more messy than it is now, that I've chosen not to until the dark blue pitchfork is finally condemned or retired. Now there is one more option, and is one I've chosen to consider for now. I've seen so many breaks in pitchforks in my life that I have noted a somewhat common factor in some of these breaks, and that is the market will run along the top side of a broken upper tine for some considerable distance, and thus still keep the original broken pitchfork working after a fashion. This is the idea I will use for now. One final point, and that is to consider the hesitation over the end of April into early May, around the stratified levels between 97.50 to 99.95. Could this be a possible halfway hesitation? It certainly has elements of such a pattern. Hence how I've placed a provisional target X in the 11,200 area overhead as potential for such a pattern, just in case. Now I know it is close, but it still has merit. LME 3-month aluminium. The current moves higher originate back in late February, with the market breaking higher from a diamond pattern type formed between late October 2023 to late February 2024. I grant you it was not the best looking diamond pattern type, but as I said repeatedly back then and ever since, it had merit, especially on the break higher. However, the market took its own sweet time in moving up to the top side targets, but get up there they did. The next feature was something I pointed out 9 weeks ago, a bullish bow tie formation of the moving averages. Now this was due to kick in between the 9th and the 16th of April. As you can see from the daily chart, the 15th of April was when we had the big spike higher that ended up actually as an indecisive doji cross of all things. This huge move showed the extent of the market for the next few weeks as part of this move. Now, as part of this move, we had a gap higher over the weekend between the 12th and the 15th, and we spent the rest of April and early May gradually moving down to fill in this gap, which was done early last week. Since then, prices have started moving back up, and we're now threatening, well, we've punched through it, but we're now threatening the high on the 15th at 27.28. We haven't closed over it yet. Now, I spoke on this 2 weeks ago when I said, and I quote, "We need to see the gap in mid-April between 25.12 to 25.35. We need to see this filled, and relatively soon. If after this the market continues lower, then recent action will have been a peak. If not, then this may become a staging point, even a possible halfway hesitation for a move higher." Okay, so before I indicate the opportunity for a bullish halfway hesitation, I'd like to highlight the dark blue, late April, mid-May bullish Andrews pitchfork. This market is at the moment between the lower time below, currently at 25.70, and the middle time above, currently at 27.78. Now, my reason for highlighting this bullish pitchfork is because I would look at these dark blue tines as a guide for the way ahead and for the way high until they stop working. Okay, so if we were to regard the action since late March today as a potential bullish halfway hesitation, then it does give us potential up to the 29.20 area overhead. There are a number of roadblocks along the way, one of which may have been overcome today, and that is the congestion between the 50% Fibonacci line of the 2008 to 2022 move at 26.75 and the 2023 high at 26.80, and may even have gone over the April 2018 high at 21.78. This stopped the rise in April and is the next one to watch. And we're just underneath it at the moment, having pierced it. LME 3-month lead. The key resistance that kept this market capped during the first third of 2024 was, as I said 10 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 21.82 to 21.89, end of quote." Now, please remember this quote has become relevant again. This capping action eventually brought forward the idea of the late January to mid-April action being a double bottom pattern type. It is here that I bring back in that earlier quote made 10 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 21.82 to 21.89, end of quote." It had been this overhead congestion that capped the market throughout the beginning and middle of April, bar one aberration, until 4 weeks ago, when prices rode up through it. I said 2 weeks ago, and I quote, "We are now over this area of resistance, so it's appropriate to consider the upside potential of this big double bottom pattern that's occupied a third of 2024. Thus, the primary target X was in the 22.96 area, whilst the secondary, much harder to reach target X1 would be in the 23.42 area. End of quote. Last week, the market rose enough to reach target X, and this week, prices rose some more to reach target X1. I'd also like to quote further from my commentary made 2 weeks ago about some feature in the recent double bottom, and I quote, "The handle is a feature of double bottoms, especially Adam and Adam types such as the one we have. It is the band of hesitation seen around the middle of April between roughly the overhead congestion between 21.82 to 21.89 and the twin 50% Fibonacci lines below at 21.51 and 21.42. One of those has actually moved since then, but 21.51 to 21.42. This is an intrinsic part of the double bottom, but it can also be seen as potential halfway hesitation. Thus, if we look at it that way, and depending where we measure it from, we have a first target in the 2240 area that has already been achieved, and a second much harder to achieve target, possibly in the 2325 area. End of quote. I know it's purely academic, but I've labeled the secondary target as target X2, and it was reached this week as well. Finally, I will look at the elephant in the room once again. It is the repeat of what I called it 2 weeks ago, the bright red highlighted mid-February to late March bullish Andrews pitchfork. Despite the breach of the upper time, currently at 23.29, this still looks good right now, as we might still see it only as a breach and prices drop back within the bullish Andrews pitchfork, or we could see the market crawl along the top of the upper time. The next big obstacle overhead is the 50% Fibonacci line, the big 2010 to 2011 move at 23.78. I'll be interested to see how the market reacts or does not react to this 50% Fibonacci line.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.